Well, let's talk about the big picture for U.S. stocks as we're headed for an all-time high close. Kevin Gordon, senior investment strategist here at Charles Schwab, joins us this afternoon. We've talked about the momentum, some of the leadership, and the options moves in this market. Kevin, you love to go underneath the hood, so tell us what you see when you lift it up.
I think broadly participation over the past several months, I kind of like to take it back to the mid-July peak for the S&P, the most recent, kind of major peak this year. And since then, there has been, a broadening out in participation. You've still seen, even though tech has done well off of the August low, since that mid-July peak, tech has really taken a step back and continued to take a step back. I would throw communication services in there as well in terms of its leadership status and really giving more of a runway for the rest of the market to catch up. So I think it's an important thing to look at and profile to look at, especially as we're approaching the 2-year anniversary of the bull market, which for the most part in the S&P 500 looks relatively healthy. A little bit of a different story down the cap spectrum. It's the weakest 2-year start to a bull for the Russell 2000 in its history. So there are nuances down the cap spectrum, but I think it's also, part and parcel of the environment, the unique cycle that we've been in.
Okay. So the leadership as we go into earnings, what are your expectations? Because we're making highs with a pretty nice little balance right now. Some of the tech stuff is doing really well, and some of it's kind of mixed. The Mag 7 is not quite as robust as it was. So what's the earnings vibe looking like?
Estimates for the current quarter, the season that we're about to go into for reporting, they got cut pretty aggressively. I don't think that in and of itself is necessarily a bad sign. I think, as has been the case over the past couple of years, certainly in the post-pandemic environment, a lot of the focus and the emphasis, I think, shifts to the commentary and what companies say, specifically as it pertains to maybe a quarter or two looking ahead. And tied in with that, I wouldn't say that the earnings data itself, yes, it's important, but I don't think that that's the major driver at this stage. I think that revenue probably becomes more important, especially when you consider where we're at in the labor cycle and the fact that revenue strength tends to be the main driver for hiring and firing decisions for companies. So if you don't see the revenue picture improve at a similar clip that the earnings picture has, because earnings growth has been outpacing revenue and a lot of companies have been achieving strong earnings growth via aggressive cost cutting, which is fine and it's normal to see in a cycle. But if you're going to see this really, sort of elongate and see the bull live on longer, both the economic and the market bull, then you would need to see actual revenue growth kick back in. So for me, that's more of the focus for the second half of the year in terms of reporting, and then as we turn the corner into 25.
Okay. So to go along that point, you're kind of answering some of it, but given the employment report last week that was so strong, does that raise the odds of that revenue pickup? What's the connection between the economy and earnings at this point? Should we feel better about that earnings potential now that the economic data are beating expectations?
I think it does because, in an aggregate sense, you're not seeing broad-based layoffs across the economy. It's so far been concentrated in certain pockets and certain sectors. That's why we've been able to go through this, really slow slowdown for something like payroll growth and a relatively gradual pickup in the unemployment rate. And the fact that the labor market is not on the brink and it's not, sort of slipping into an imminent recession, I think is the sort of key there in showing how companies are relatively confident still that they can kind of push through with the revenue side of things. Obviously, if that doesn't come to fruition, then you have a little bit of a different labor picture. But all of the data that we've gotten over the past several months, whether it's, you sort of start with a downward revision in the preliminary benchmark revision for payrolls, where you had almost 900,000 jobs revised out. And then you look at that in conjunction with GDP and GDI, which were revised significantly higher over the past few years. That just tells me that the productivity story is a lot better and that sort of unit labor cost and inflation, coming from unit labor costs has come down significantly. So I think all of that is still a good mix and a healthy mix for a relatively strong revenue environment. It just needs to be broad-based. It can't be one sector because as we learned from, the past couple of years, some of these imbalances, whether it's the Mag 7 versus the rest of the market or tech as a sector versus the other 10 sectors, that can only happen for so long where one is carrying or just a few names are carrying things. So I think that as we continue to move, into this environment where things are becoming more balanced for the Mag 7 versus the other 493, that's a good thing. But again, it needs to show up on the revenue side too, which is for the most part, been the case.
All right. And to the point about the underperforming groups, Russell got back on its feet today, but continues to have kind of a tough go of it. Should we pay too much close attention to that as an index, or as you've argued in the past, so much diversity within that cohort that we should be generally just concentrating on factors, styles? Because Russell keeps getting stopped out, it seems, at the same levels.
Yeah, I still think it's a tough index to look at, as a monolith because all companies are just not the same in any index, but also, especially in that index. And I think for the Russell 2000 as a whole to really rally, and I mentioned earlier the weak start to this bull market for the Russell, for that to really, get up and going. In history, it's consistent that the outperformance or the strong performance of the index itself, but also the outperformance relative to a large cap index like the S&P really only happens after you go through a much weaker economic, sort of rough patch, or you go through a recession. Clearly, we're not in that environment right now. So I could see the case for adding to small caps gradually and definitely moving up the quality spectrum in an index like that. But if you're an index oriented investor and you're more tied to the Russell 2000, probably still going to be a relatively frustrating climb because that gap between large caps and small caps is still pretty wide over the past year or over the past couple of years.
All right. Great stuff. Thanks, Mr. Gordon. Appreciate that. Good close to the session here. Senior investment strategist at Charles Schwab.